EBITDA growth for the BSE 500 corporates have been on a declining trend post FY12 and touched a low of 4.1% during the first half of FY16. Our expectation is that the growth for FY16 would remain in the range of 5 to 6% and increase to 9 to 10% during FY17. We think there is a correlation between nominal GDP and revenues and EBITDA growth numbers for corporates. As nominal GDP has seen a secular decline post FY12, this has reflected in the nominal figures for corporates. However, while revenues have declined more sharply, EBITDA growth numbers have not declined as much on account of benefits of commodity prices. EBITDA growth is driven by four macro factors. If I were to expand that, it's investments, exports, private consumption, and government deficit. Given our expectation that investments, especially from private sector and exports, will remain subdued, consumption and deficit are the only pillars which could potentially contribute to growth. However, benefits from private consumption could also remain muted in FY17 given the trend in inflation, leaving us only with government deficit. If the government continues on its path of consolidation, EBITDA growth rates are likely to remain in a single digit. However, in a hypothetical scenario, if the deficit expands by double digit, the EBITDA growth rates could touch 12 to 14%, but will remain short of the 17 to 20% achieved post the financial crisis. In our view, those levels are unlikely to be touched unless investment, especially private investment, picks up in a meaningful way. In our view, sectors like auto, pharma, telecom, power and textiles would continue to show earnings growth in FY17, whereas downside risks could exist in metals and mining, upstream oil and gas, and possibly cement. However, for the overall corporate profitability to improve, sectors like auto, metals, oil and gas, telecom and power would need to grow in a meaningful manner. Given the leverage challenge that corporate India is exposed to, the process of deleveraging over the next 2 to 3 years is critical, and unless earnings growth picks up, credit challenges could only increase. The time required for corporates to deleverage could take 3 to 6 years, and this could keep pain in the system for a much longer period of time.